Welcome back. A mortgage is often the largest debt people have, and many people want to know if they can pay that debt off faster than just making the minimum monthly payment. Joining me now is mortgage expert Tyler Osby. Tyler, we're talking about paying your loan off faster. We've already covered in another segment putting a large lump sum onto your loan, but today we're talking about ways maybe think smaller. So what have you seen in your years of experience about people wanting more information about this?
Yeah, well, people are intentional about it. They start from the beginning asking questions about, hey, I'd like to pay this loan off more quickly, which we love, right? Oftentimes there's different approaches. Some people just pay a little extra money, like maybe they've got a $1,250 payment and they want to round up to $1,300. Or maybe they want to make one large payment, which relays back to that segment we did previously. And lastly, a very common theme is doing either bi-weekly payments, so you pay every 2 weeks, which then becomes one extra payment each year, because people who get paid every 2 weeks, they have 2 months a year that they get 3 paychecks, right? What we found in terms of math is with the third one, it takes a 30-year mortgage and really turns it into like a 24, 23-year mortgage, depending. So pretty significant savings, but there's some things to consider, and we'll get to that.
For sure, and we want to talk behind garage door number 2 about the principal payment, right? That's the principal is the part of your loan that you actually want to pay down. Of course, you have to pay the interest, but how do you make sure that any extra money you have to throw at your mortgage actually goes to the principal?
Well, there's a couple things to keep in mind. The first is you want to make absolutely sure you've made the minimum monthly payment first. Some people miss that, and that can be a problem. 2, it's really important that you specify any extra money you're paying is going towards principal, because if you don't specify it, one of two things could happen. One, they could take that as a future payment towards interest, which seems really stupid because it is, but it happens. Or they might put it into escrow for taxes and insurance, which if that's not your intention, you don't want to do that. But just know that any amount that you pay extra towards principal counts. They will take that as an additional payment, as long as you've made the original payment that's due before applying it.
Okay. Behind garage door number 3, we just have some other things for you to think about if you want to do this. So what's your advice to people who might be wondering, oh, is there any penalty if I do that? Yeah,
so the good news is, for the most part in Iowa, it's very unusual to see prepayment penalties, but you should always check, because it could happen in a rare instance, and you certainly don't want to accelerate the payoff of a loan if that prepayment penalty is going to hit you. 2, you want to know exactly how that extra money is applied. So a really good way to do that is to keep track yourself of the additional payments you make. A lot of people will get an amortization schedule, like maybe print it and manually, pen mark it up. Or there's a lot of really helpful mortgage calculators online that'll allow you to use principal reduction and see on an amortization schedule how those extra payments would actually accelerate the payoff of that mortgage.
All right, good stuff, Tyler, thank you. If you would like to share what you've learned here today or check out some of our other HomeWise topics, visit WHO13.com.